shield that protects exporters against risk of non-payment. It covers losses arising from commercial risk and political risk. In many countries, issued by export credit agencies. In Nigeria, it's issued by Exim. In US, issued by US Exim Bank. Now, you see this instrument is one of the most powerful instruments currently used by China to penetrate different parts of the world. You know, China is faced with challenge because of US. So they told the provinces, number one, give a cheap loan to your manufacturer. Number two, give them a medical credit insurance. Now, export credit insurance means I can go to any market to develop the market for the business. And if I don't get paid, the bank, government institution will pay me. Now that way, it can make me to take more risk. And because we need to diversify our export market and reduce our reliance on US, we must take that risk. And the market that have higher risk, we are protecting you. So it encourages businesses to go to different markets. It ensures the risk of not getting paid. That's export process. Now, how does it work? EFTA should be good on credit terms. EFTA take out an export credit insurance policy with an insurer. Buyer default due to insolvency or political issue. Insurer indemnify the exporter for a major portion of the transaction. So typically the government will insure 80-90%, not 100. 80-90%, which will cover all your costs with some profit. Now in Nigeria, unfortunately, this is supposed to be the job of Exim Bank, but Exim is unable to do it because they are not well funded. They are not well funded. They don't have the money to do this. But it's one of the products listed on their website that they're supposed to be doing, and that other credit agencies around the world do. A Nigerian that sells SPC worth $500,000 to buy in Turkey on 120 days open account terms. They have started out export credit insurance policy with Exim Bank. If the Turkey buyer failed to pay because of bankruptcy, the insurer reimburses up to 85 to 90% of the loss. This protects the exporter's cash flow and reduces the losses. As a trade finance instrument, it gives payment assurance, transfer risk, finance, support financing, giving finance access, market expansion, helping business to expand into new markets, like I talked about the case of China. And lastly, cash flow stability, ensure liquidity, because it makes it easier for banks to want to fund them. If you compare them, you see that in export credit insurance, we're already familiar with this. National insurance policy cover political and commercial risk. In fact, a number of countries do it because of political risk. They want to enter that market even when there is war. This is the only reason why Ukraine can still import. Despite the bombing happening from Russia. Because some countries will do business. In fact, some countries will do business with that market. During the civil war in Nigeria. This is the story of how Okoroko entered Nigeria. How Okoroko entered Nigeria. During the civil war, Norway was supporting Biafra because of malnourished children by giving them stockfish. And that became a delicacy. How many years after? So, countries go into those places where there is war because if they are able to penetrate that market in that period, when the war is over, they own the market. So it's actually a strategy, deliberate effort by countries to be able to dominate some market because they know if they are able to enter that market, understand the market, satisfy the market needs, and be able to curtail the risk. And by the way, what is government all about if it's not to protect your business? Because they are the one creating the job and paying the taxes. That's why some countries in Europe, they can give £1 million, €1 million to businesses, share it with them, to support them. They know some will fail, but they also know many will succeed. And they will pay back the taxes some years to come.